Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is October 20th, 2013 edition of Market Outlook. So we certainly had a blockbuster week. Market shrugged off pretty much the debt ceiling woes. We resolved it, and markets out to new highs. So let's take a look at where we are, what the technical conditions are of the various things we track. And first thing, let's take a look at the spiders. So you can see on a daily chart, I've got a couple of different channel lines in here. And the important things, of course, to note is one, the 200-day moving average is rising at a 45-degree or even better type of rise. That is really steep for a 200-day moving average. That's pretty steep, certainly on this type of price scale. So the other thing, of course, is that your 50-day is also now, which went sideways after that swoon here. We're trading above it and moving to a positive slope, as well as the shorter term 10-day moving average as well. So stacked and slope across the board. Also, 3 accumulation days this week or over the past 2 weeks. That's pretty bullish. And I also want you to note that the bullish days actually had greater than normal volume as compared to its 50-day average as well. So those are really true accumulation days. What I like to see is today's volume is better than yesterday, and it's also better than that 50-day moving average. That shows you some real strength moved in the market, and things are just looking pretty good here. Now, we've got a couple of things to note in terms of potential upside targets. For one, you can see that we have this trend line that's been intact since 2012, and you've had a number of near touches. Most recent one just in early October. So that's a pretty good trend line. If you wanted to, you could sort of tighten it up a little bit on a closing basis, but essentially this is really the trend line for one day or so. You sort of spiked through the trend line but never really closed there. Now, in terms of getting an upside target, since we're using the basic wicks over here, you can see that this trend line here or channel line going back well over a year is using the wicks of the candle. So the low, and we're going to match that to the highs, and you can see upside target well north of 180 on the bigger channel, right? So this is the Y channel. Within the channel, you also have a smaller channel, right, which is basically this right here with a parallel up to the recent tops, and you can certainly see we're getting close there. So you might hit some resistance as you get up another 2 or 3 points on the S&P 500. But upside target, certainly you want some caution there. Now, obviously, we want to take a look at some of the momentum. You can see our short-term RSI. We really look for it to get to like 97 or so. We're at 93. And of course, these things can get even more extended in a really big parabolic move. So not really giving us a read here of overbought quite yet. So for the broad market, things are nicely intact. Let's take a look at some of the market internals. Well, here we have it. Just in the last week and a half or so, you actually got oversold and turned back up on the McClellan, which is our intermediate term oscillator. And looking at this, you basically got a buy signal pretty much on the gap opening on the lows back about 6 or 7 days ago. Now, shorter term, the 10-day advanced decline and up-down volume, which we like to use all in conjunction, are starting to get rich, but there's plenty more to the upside. And the up-down volume ratio, the number of issues up versus declining, has not even reached overbought levels yet. So, with the liquidation of a lot of people being nervous over the debt ceiling, still more room to the upside. Obviously, we want to be cautious and watch when the market flips back down under those key red lines here. But so far, we still have more room to the upside. Now, let's take a look at sentiment as well. Sentiment has now moved where we had this huge spike, VXX. We actually traded this off the bottom, anticipating some issues with the debt ceiling and a blip. We caught this move up nicely and exited as it moved towards the upper end of the Bollinger Band. So right here, everything seems to be in gear. We're trading under the 50-day moving average. No irrational exuberance yet. I mean, yes, we are at the lower edges of the Bollinger Band, but it still has some more room to move to the downside, which would indicate irrational bullishness, but we're not there. So overall, trend is intact. You can see the VIX on a weekly basis did close at its lowest close, and let's take a look at this. It's quite some time. But you can see in terms of the band here, well, this is certainly the lowest close that I have here on the time series going back to 2010 or so. So this is the lowest close, but on a recent basis, looking at the Bollinger Bands, we like to look at irrational exuberance sort of when it gets to the upper end of the bands or the lower. We're not there, but on an absolute level, we're definitely declining, which makes sense as the volatility definitely contracts as markets head out to new highs. Okay, let's take a look at bonds. The 20-year Treasury bonds had a nice pop this week after the settlement, in Congress with the debt ceiling. But interestingly enough, you can see we're recovering off this 50-day moving average. It's still pointing down, and not all that convincing. Like to see these recovery phases in a situation where the 50-day is rising and I get an opportunity to buy a retracement against that 50-day moving average. But nonetheless, that was a pretty healthy bounce off of it. But the other thing is that you sort of cast in between this 104 level, which is important support, right under this 50-day average and under the lows of Wednesday are your critical levels. We break that, that would not portend to be good things for interest rates and the market in general. Higher rates would not be good for the market. Now, the other interesting thing to note is that on Friday, we attempted a rally, but we had a slingshot pattern, a key reversal day where we made a new 60-day high and closed at the bottom end of the range. That's not good. So we really want to see this market either above this 107 level from mid-August. It's about 107.70 or so, and that would tell you that the TLTs are in a strong position. But you're still relatively positive until you break down under that 104 area. So that's it for TLTs. Now, also please note that on the monthly charts, our super long-term trend still intact, right? So Fed tapering, keeping these bonds still on a long-term positive trend. But of course, things have eroded on the weekly and daily charts. We're just now into a recovery phase. So it's interesting. Recovery phase, bounce off the 80-month moving average. Again, a close under this key this key area. Uh, Certainly a move under that 104 level would most likely bring you a test of the recent lows, and then beyond that would really tell you that the super long-term trend in bonds is finally broken. As of now, still intact. Now, let's take a look at something else that is really important for us as Americans, if you are. We do have many foreign traders, but here in America, something to really keep an eye on is the fact that this is the ETF of the Chinese currency, the yuan, and you can see on Friday we closed on all-time new highs against the dollar. Now, there are a number of different ETF currency plays. However, CYB is the most liquid and the most tradable. Doesn't have a huge range. I mean, a lot of this is controlled by the Chinese government, but they're trying to, move away from that level. But it's slowly allowing the thing to more freely trade. So the CYB on all-time new highs, not really a good sign for the dollar. Let's take a look at what's happening here on the dollar. And this is a basket of currencies. So even with the settlement of the debt ceiling, which definitely put pressure on the dollar. I mean, these are some of the unintended consequences of Capitol Hill fooling around. The confidence in the dollar, even though we settled it, clearly is pointing. Look at this. This is a basket of currencies. We're clearly closed on the lows here with this gap down, and even with the thing settled, the dollar just continues to drop. And so this is, it closed basically on the low in well over a year on this basket. So let's keep an eye on this. This looks like it can certainly, if this is what I would consider major topping formation, this is not a healthy sign for the US dollar. That that is something, again, to really pay attention to, because if we start eroding our reserve currency status, it can have wide-ranging implications, and this is where the fallout is from that debt ceiling issue. Now, let's take a look at Google. And you can see Google, just huge breakaway gap, and the market is hit well over 1,000. Just explosive move across the board. Let's take a look at a longer term chart. And this is the type of situation where, and let's get some more data here. I'm going to format the symbol and look at some more data. This is 20 years back. Okay, so now this goes back to the beginning of when Google went public, and you can see we hit, almost $700-800, and it took several years for the thing to finally move. But one thing is for certain: when things go to all-time new highs, there's no telling where this thing can go, and this move may just really be starting. A lot of the investment that Google has made over the years in the operating systems, especially the mobile platforms, is starting to pay off. Mobile ads, mobile computing is the future. People are leaving their PCs. Mobile phones obviously are getting bigger screens, and they're almost like full computers these days. And the whole process of Google selling ads on mobile phones is really coming into the fore. So this is a mega trend in the happening. Obviously, with this huge move here, we want to see the market really hold 1,000. More importantly, the market's going to this stock is really strong above 900 to 920. So major bull market intact. here with Google. More importantly, I think the fact that Google is an industry leader points to a good psychological boost to all equities, right? This in certainly the social media, anything in sort of the new age technology, including biotechnology, um, although that's been showing signs of potential exhaustion. But overall, tech related high quality stocks is a positive sign for the market. So, this, I think, is good fuel, important fuel psychologically for our U.S. equity market and global equity markets in general. So, let's keep an eye on this, make sure that Google stays strong, and that's an overall good sign for the market. Now, one last thing is we talked about solar being pretty good. You can see this is First Solar, had a really spectacular move on Friday, up almost 9%. But more importantly, if you look at the chart on the monthly, this stock was, wow, $300 back in '08. It's now trading 50. And you can see that you sort of have this flagging pattern, and we're moving out of this long-term base as well. So this is something to keep track of. Solar stocks definitely on the move. This move with First Solar really explosive, looking good. We'll keep an eye on those tech stocks and some solar as well. Okay, that's it for now. Hope you enjoyed it. Glad to be back after a little bit of a hiatus, and see you next week. Stay frosty because these are interesting times. Thanks and bye for now.